Ladies and gentlemen, please welcome Steen Jakobsen.
Okay. Thank you, Edwin. It's a small topic I got in front of me today, trying to give you an answer to probably, in your lifetime, the most important question you have to answer in terms of your business life and your business role. I'm a bit humbled to be in front of so many intelligent and not least beautiful people this morning. But what is American exceptionalism? We all know about the soft powers of American movies, the fact that most kids when growing up, at least in the Western world, but certainly also in the Asian world, wants to go to America, they want to go to a US university. But what I'll talk about today is the hard facts, the concept that once in a lifetime, once in a generation, we do see that things change dramatically. The tectonic plates, for reasons of time, for reasons of randomness, but often because of the stupidity of politicians, get to turn things around in terms of how we perceive things. It's important to know that when Trump says that everybody's having fun at their behalf, we need to understand, and I'm sure you fully understand, that the fact that the dollar is the reserve currency of the world means that their funding costs in all surveys ever done academically and practically means that the US funding rate, on average, is about 100 to 200 basis points lower than it would be without it. In other words, when the US funds itself and it's 100%, 120% debt to GDP, the cost would be not 4%, which is the level right now, but it would be 6 to 7%, which basically means that the US, in economic terms, is the equivalent of an emerging market. The other thing is that, I don't know how that came about, but maybe it's the lack of the big institution in the US, but a current account is pretty simple. It's probably, for an economist, the most honest formula that you can use, because if I have a surplus, someone else needs to have a deficit. So it's very difficult to cheat on the scale in what goes on. But what you need to understand, because that sits at the very center of what I will discuss right now, is the fact that a current account reflects ultimately the net saving rate of a country. So the UK, you are becoming Americans, you're spending more money than you have. So you have a dis-saving as an economy. The US has one of the biggest dis-savings in the world, having a total debt level of $32 trillion in a $30 trillion economy. When you have a deficit, you need to fund that unless you have domestic savings big enough. So the issue that the US have is that the saving rate comes way short of its ability to refinance itself, to the tune of 30 to 40% of the total flow that needs to come. So the US needs to attract capital in two ways. It either needs to make the yield on the debt they issue high enough for you to find it attractive, or they need to make the currency equivalent of that very, very cheap. In other words, the dollar needs to be cheap enough for you to see a deal in buying the market because of the currency exposure. So American exceptionalism in the newer version has been the following. Since '98 and Greenspan distorted and ruined the moral compass of financial markets by bailing out long-term credit, the 2008 follow-up, which really was just an exercise of putting a huge amount of debt on the public balance sheet from the private sector, through to, of course, 2020, the COVID initiative that happened that exploded the amount of debt in the world. So American exceptionalism is nothing but not having savings, but also at the same time living in a world where they constantly is outperforming the rest of the world in citation marks, only because they continue to do fiscal deficit to the tune of 6 to 7% of GDP. So there is nothing exceptional about the US, except for the fact that they own the number one strategic measure that you need in the world to be a world power, which is military might. In comes Donald Trump, and he decides that this military might and its ability to protect its neighbors, its friends, is no longer, one, free, which is only fair, obviously, but also he needs to and wants to redesign the whole global system because the US is having the short end of the stick in terms of the financing. As you can see from this slide, there are, as I said, generationally times where things change. The big one for the financial system was after World War II, Bretton Woods was established. And then in 1979, we had the Nixon Doctrine, where they went off the gold standard and allowed the global currencies to free float. And now we have Trump's non-liberation day on April 2nd. These things changes things because they changes the way that people perceive the countries. I today have clients and people I talk to in the marketplace in hedge funds who is supposed to be some of the most informed, that no longer wants to put their collateral money in T-bills, not because they're afraid of the US ability to pay, but simply because they think they could run into some sort of a limitation on the mobility of the capital or surcharge on the capital. I find that's pretty unique, and probably the first time in my 40 years that I'd encountered such a view from hedge fund managers. We see the traffic in terms of tourism is down 50%. We see the amount of containers coming into Los Angeles ports. It's down 40 to 50% going forward. It comes, of course, from the tariffs imports. But what is important to understand that the unintended consequences that comes with these policy measures is vast, and they are very, very significant. The US today will not be able to finance itself over the long term unless they step back. But we also have to remember that this is all self-inflicted, similar to what happened to the doctrine in 1971 or the tariffs that we had in the 1920s and 30s. These are policy measures, policy mistakes dictated because of wanting to do the right thing, but as it is often the case with politicians, they have good intentions, but very little IQ and very little ability to actually execute. So we end up in a situation where the ability for capital to sustain what is going on is going to be very, very difficult. It also has created a huge momentum surge in the rest of the world, in particular in Europe. I was shocked, I have to admit, when I saw the German election. Going into the German election, and I chair 3 macro meetings a week with international investors, all the Germans kept telling me nothing will ever happen in Germany. It's going to be more of the same. It's going to be a coalition government, zero ability to have a political movement. And fast forward to today, where yesterday Chancellor Merz was put in office with a program that's going to spend, and hold your horses here, 1 trillion euros over the next 10 years. 1 trillion euros. The cheapest countries in the world in terms of spending money, it's turning into one of the most prolific spenders because they realize that there's a huge deficit on infrastructure spending, but in particular on the military spending. During the might of and the height of ESG and all this, and I'm sure I'm going to offend a few people, so apologies ahead of this, but 4 years ago, everyone who was in wealth management, anyone who was doing banking said, there's no way our customers should be exposed to cigarettes, which I fully understand, but they also said we should not be defending and investing in military companies. My counter to that is, what is the purpose of having a strategy and a country that cannot defend itself, but have the right vogue opinions about ESG? I think the very essence of our life is our ability to defend our constitution, and through that constitution, not engage in war, but engage in a level playing field where the ability to defend yourself becomes not only a call for action in terms of creating a national identity, but also not lazily saying that military spending is highly correlated with productivity in society. If you look at Europe and productivity in Europe, and I indirectly gave you the answer now, when do you think the peak of productivity was in the last 50 years? 1989, when the Berlin Wall came down, we had the great peace dividend. There was no reason for us to have a military. In Denmark, there was actually talks about replacing the military with an answering machine that said, when you called it, we will surrender. That has changed. Germany has changed. Europe has changed. What has not changed yet, of course, is that a lot of you will say this, and when we come to the investment part, it's probably one of the reasons why you're sitting around and like on the Titanic when it's sinking, arranging the deck chairs, you're saying, maybe we should reduce our exposure to US 1 to 2%, instead of really grasping and dealing with the fact that going forward, the US as a reservoir of capital will be smaller, not because the US wants to, but because the rest of the world doesn't want to finance it anymore. But the investment part, and this is, sorry, all the short names, but I'm sure you know it. TINA, of course, stands for There Is No Alternative, which is really the same question that I was being asked in this speech. Is American exceptionalism over? And TIA is, there is an alternative. But the problem we have is very, very clear. Here I've added up the size of the bond markets and the equity markets in total size of the global market. So in other words, you can see if you read across the first line, the US is 50% of all public traded entities in the world and listed bonds. So if there is a conversion towards spending more money in Europe, the Middle East, and the Far East, the issue you have is that the reservoir or the pocket to which this money should flow is way too small, relatively speaking. Here in London, you have a specific issue that the London Stock Exchange is seeing a huge amount of companies listing in the US because they get higher valuation, or even delisting in the UK because of the same metric. I think that will reverse. It is a very dangerous call to do because, of course, it sits against everything you believed in the last 30 years. Don't forget that the underlying assumption you have when you invest on behalf of your clients has been that I need to find the best sort of assets in the market. But underneath that, centrally has always been that I don't really have to take care of the currency risk. I think it's very, very likely that over the next 10 years, because that is exactly what happened after Bretton Woods, the tariffs in the 20s, the market in the 70s into the 80s, is that you have, and don't worry, I'm not going to talk about the collapse of the market, but you will have a real return in the most liquid markets of the world that after inflation is giving you big fat zero. What you then will have is that you probably lose on average 5 to 6% a year on the dollar going forward. Because when you have a situation where the debt level is too high, so high in the US that you no longer can afford to increase the interest rates because the burden on the US budget is $1.2 trillion a year just paying interest. Today it's about 13 to 15% of the total budget. But with the projection and what Trump has in hand in terms of tax cuts, we will be paying $2 to $2.5 trillion a year, which is too big an amount relatively to the budget size, but certainly also for the ability of dealing with, which is the central issue in the US, the social fabric being torn apart, the social fabric doing to American families what normally happens only in wars, that is that they can't talk to each other. They can't even get around and discuss what is going on in their lives because 35% are pro Trump, and 35% is against everything Trump does. So this ability and social fabric is also being mirrored in the global scene. Yesterday, again, we were very close to 3,500 in gold. And let me ask you this central question. When I do advice for family offices and clients, they may be in Norwegian kroner, they may be in sterling, but I ask them, very kindly, as kindly as I can, would you please show me your numbers in gold? Because the next 10 years is going to be about how do you retain and keep your purchasing power in a world where you have a constantly devaluing US dollar. You may not see a total collapse of the US market, and certainly you're not going to see US exceptionalism totally disappear. But underneath, at the micro level, a huge amount of capital is going to flow into Europe, into Asia, into the Middle East. And certainly what we see when we see the German government spending 1 trillion euros is that, remember, that is the same 1 trillion euros that used to go to the US to finance the US deficit. It is also the same kind of money that is no longer flowing out of Saudi Arabia because oil is trading at $45. And their deficit is so large that they need to put and turn their capital from being capital exported into capital consumers. In this week, you probably saw the headlines that the Taiwanese dollar increased by 10% in one day. Why did that happen? It happened for exactly the reason that we have this subject on the stage today, but also because they want to deal with the uncertainty as a concept. And they are telling themselves, if I'm no longer going to be invested and taking my excess capital to the US, I need two things. I need an investment domestically or locally, and I need to hedge the currency exposure. Right now, in a huge amount of European, certainly continental European pensions companies, they're going to have investment committee meetings. And one thing I do know about the pension sector is they are extremely slow. It's probably the only sector in the world that makes politicians look fast. But they are looking at huge amount of losses because over the course of the last 5 years, they invested in this concept of American exceptionalism, and even more so, they all bought capital-weighted indexes, where 7 stocks constitute 30% of the investments, meaning that capital in a pyramid way is only really going to the small amount in the bottom, or the top, whatever way you turn the pyramid, but very small amount of capital actually flows to the global economy, leaving us with very little spend on CapEx, very little strategy except for maximizing the next earnings per share call. And one of the targets that is upcoming will be, as you can see at the final column I put in here, is CapEx, capital expenditure. I was shocked when I researched this number. The total 5 countries in the world only spent $2.3 trillion on CapEx. I just told you the interest alone in the US budget is $1.2 trillion. So maybe, and here it gets interesting, maybe the ultimate direction in which we travel here is not that the US market needs to collapse for us to satisfy the premise that the US exceptionalism at a bare minimum is slowing, but maybe even being, disappearing. It is the fact that the pocket of capital where money will go and where you need and where you will see over the next 5 years, huge amount of excess return is in the CapEx space. But remember, if you increase the CapEx in a company, you reduce the retained earnings. Actually, one of the big reasons from a bottom-up perspective why equity has done so well is because no one's ever spent money on CapEx. You're really, literally not investing in your own product, which is the reason why we have this very interesting concept of when you buy cookies or milk, whatever, it's still the same price it was 2 years ago, but you get 40% less of it, right? Because the product has not evolved. So the ability of the economy to constantly renew comes from the fact that if you are an economist, and I think the most useless education you can take, to be honest, There may be some are worse, but one of the worst is an economist, because we never learned anything. We never predicted anything, and we certainly can't do anything practically. But if I was to give you a certificate of having an economics degree, I could do that in 10 minutes. I will tell you there are only two factors that drive an economy. It is demographics, which is really a sex policy, which I'm too polite to talk about. And the second one is productivity. So if you think about your next investment committee, or any investment decision you're going to take over the next 10 years, you need to ask yourself, what I'm about to engage in, or what I'm about to do, will that detract, subtract, or add to productivity as an investment? CAPEX is increasing productivity. Even fiscal deficit, even in the UK, can be productive if it goes towards energy solution, build out of the energy grid network, better drones, better internet, better ability to take off from Heathrow and the likes. So there are deficits that are negative in a context of productivity, which is transfer income, sustaining the economic model, where the system just gets expensive because it gets expensive, not because it's not needed, but because the system is not productive in itself. So all your scale for doing investments over the next many years will be whether you have the ability to find productivity pockets. Military spending is hugely productive. Because if you think about it, the one thing the government cannot do is produce radars, better technology. I mean, the reason why your kids have Velcro, the reason why you have GPS, the reason why you have, pants that are surfaces that works is military spending. All of these things come from military spending. So it's not that we need to build bombs. And by the way, the modern warfare, as we've seen in Ukraine, is not about having military equipment. It's about the technology and the surveillance and your ability to predict what goes on. That is also why the technology war and AI and the likes is going on. And probably a few of you have seen this, but the reason why this is not going to go away, and I know a number of business people, and I listen to Bloomberg every day, and the CEOs, I heard the CEO of BMW, he said, he was asked, what is your charge on the tariffs for BMW? He said, it's about €1 billion because it's going to go away ultimately. That's mistake number one. If there's one thing Trump believes in, wrongly, it is that tariff works. The very principle on which he's built his whole so-called economic policy is that he's going to take a tax revenue out of tariffs and utilizes it to cut taxes and reduce the red tape. Into this space comes the fact that the only trade deal we need, UK, is not between the UK and the US, it's between China and the US. And this picture illustrates very, very well what is going on. Trump reading his own book, and of course, President Xi reading The Art of War by Sun Tzu. And if you look at what is going on domestically in China, and I give you, this is very, very important for the next 6 to 12 months. China has zero appetite to engage with the US. I also need to tell you, never in the diplomatic history of China have they approached the US on their own. There is one exception, and that was after 9/11, where China reached out to W. Bush to send their condolences. Once in the whole history of foreign policy in China. So every time you read a headline that Trump says the Chinese has reached out, there are backdoor talks going on, it's not the case. And if you don't believe me, then I just took the headlines here. I have one board job that is associated with a Chinese company, and they are extremely frustrated in China. But what President Xi is doing, it is to mobilize the Chinese population to deal with a world where they are not exporting to the US, which is not US-centric. He's consolidating his political power in order to deal with that economic problem he has at home. So it is an excuse, but more importantly, and this is quite controversial, my Chinese insider, my Chinese friends keeps telling me this: if China is able to sustain and deal with this breakdown in international relationship, then Taiwan is next on the agenda. Because think about what would happen if China went into Taiwan. There would be a huge amount of global sanction and the likes. But already now, they are dealing with 145% tariffs from the US. So if they can deal with that, they can also deal with an international community that tells you that this is not okay, similar to what happened to Russia after Ukraine. So getting off the SWIFT, getting off all this is part of the story. But the concept that they're going to break back down and do nothing is not there. Just reiterating here, please, when you do your annual reports, do it in your currency, but also do it in gold so you can see whether you're actually keeping the purchasing power. And now to the good news. I think I've been a little bit too dramatic here. So I have this 90-10 rule. I don't know if you know this, but S&P 500, 90% of all the assets sitting on the balance sheet is intangible assets, IP, cash flows, and the likes. Only 10% intangible assets. But we live in a world where you've seen signs that the real economy cannot deal with the demand of the intangible economy. The best example, of course, is data centers and their use of electricity and the shortage we have in terms of grids. There's a reason why people who trade electricity all makes 100, 200, 300 million pounds a year trading electricity. It is the inefficiency of it. The cables going across the ocean from Norway to UK and other places are simply this big. They are not big enough. We have underinvested into this structure. But more importantly for you as investors, this is one of the biggest opportunities you're going to get for the next 20 years. So I'm stating that in order for the for the unreal, I was going to say, but for the intangible economy to keep humming along at the speed at which it's doing, you need to grow the size of the tangible economy. And that's beautiful news, and not least for your children, because what is needed over the next 10 to 20 years is a build-out of all things in the real world. Grid networks, it's engineers, it's road builders, it's toolsmiths, it's all these things. So where we, since the introduction of the iPhone and the internet as a combination, pushed society into a dimension where we no longer have the capacity to build unless we build the other things on the side as well, will mean that I believe over the next 10 years, we're going to have a revolution in energy. I think fusion energy, and I know people have been saying that for 35 years, I think fusion energy is right here around the corner in 5 to 6 years. The good news is UK is one of the leading countries in the world on this technology. But if not, fusion, something else would come along. I think the world will deal very aggressively on the productivity side of things, not because they thought about it, not because it's a plan, but simply because we need it. So the 90-10 gives you a huge amount of opportunities in terms of the allocation that you do to the marketplace. And I think personally, and ending on this note, that I could be wrong, and as Edwin said, I've been doing outrageous prediction for 25 years, where the whole purpose is to provoke you into thinking things that shouldn't happen, should happen. And before you ask me, 2.5 of these predictions go through if you allow 3 years. So quite a lot of outrageous things tends to happen. I think the problem with doing these outrageous predictions over the last couple of years has been the very fact that the world itself was more outrageous than our ability to think the outrageousness into it. But I will say this, as the inventor of this publication, that I think the next 20 years is going to be the most productive 20 years in history. When you combine technology, cheaper energy over time, the need for investments, the rebuild of military strategic warnings, I think we stand in front of a world where the best jobs are not with Google, because you can hang around and playing pool and get the best food, but because you work in a company that's actually part of the solution and not part of the problem. I think the turnaround I've seen in Europe is for real, if you doubt it. I know you never trust Brussels or the European at all. But I tell you, if Germany is doing it, everybody's doing it. So I will end by saying that It may not sound like it, but I am the most optimistic I've been in my whole career as a trader, as an economist. But for one reason only. It can't get any worse. Thank you.